Talking about some of the traps that investors fell into for 2023 and what you need to be aware of for 2024. Because you fall into these traps as an investor, you're going to wind up losing money, or at the very least not making as much money as you could have potentially made throughout the year. One of the traps, perhaps the biggest trap, that we were talking about before the break was this notion of watching the Fed. Are they going to raise rates? Are they going to cut rates? Are they going to pause? It was such a big fixation on that. And I think many investors kind of base their investment strategy on what they thought the Federal Reserve was going to do. And the problem is that sentiment can change very, very quickly. And that's certainly an issue, we think, going into 2024, because once again, we still have sort of that same conversation. Okay, what's the Fed going to do? I think it's pretty clear they're not going to keep raising rates at this stage in the game. But when are they going to start cutting those rates? And if you're getting too focused on that, you're going to miss out on opportunity, because certainly when you look at sort of these Fed tightening cycles and easing cycles, what happens is the market has a tendency to move sort of in front of when the Fed actually starts to ease rates. So by the time you wait to see that first Fed rate cut, you may very well have already seen the market continue to improve sort of in anticipation of that. Remember, the markets function relatively anticipatory on when it comes to these types of economic events. So I think to avoid that mistake in 2024, to make sure that you're not getting too hung up on which direction interest rates are going, this next one that we want to caution people on is one that I think is really does have some potential implications on having some very negative impacts on investor portfolios. There's a lot of hype on a very small amount of individual stocks out there these days. And it's a concept that we've certainly seen in the past, particularly in the late 90s. But right now, they're often referred to as the Magnificent Seven. And when we think about those seven companies, Google, Amazon, Apple, Facebook, Microsoft, NVIDIA, Tesla, those seven companies, so it's in the common press are referred to as the Magnificent Seven. Those have really generated a tremendous amount of return that we've seen in the market for 2023. In fact, those seven companies have generated almost a third of the total return of the S&P 500, which is 500 companies, for the calendar year 2023. So stop and think about that. If I got seven companies that are generating over a third of the return of an index that's supposed to measure 500 companies, what does that tell you? Well, what it tells you is that these companies are so large and have been so hyped up by investors that at the end of the day, they're having a disproportionate impact on the performance of the index. So here's the words of warning. The flip side of that is when the story changes for any one of these seven companies, and the reality is, if you think back to those names I just rattled off, there's some similarities in terms of kind of the business models, very tech-oriented, very AI-oriented, if you will, then the story can change very, very quickly. And I think back to the 90s and, some of the internet stuff that was going on there. Again, you had a very small concentration of a small handful of companies that were driving the market. And ultimately, the story changes. And when it changes very, very quickly. And we think that if you're owning predominantly a bunch of index-type funds, you're going to see that disproportionately in the year 2024 when things go potentially the other way, because your investment strategy is much more concentrated than you realize. You may think that you've got a fully diversified basket of 500 different stocks owning an S&P 500 index, but the reality is that seven companies are driving over a third of its performance. And when you hear the actual raw data on the individual stocks, it's going to give you pause. And what we mean by that is when we think about the price earnings ratio, and in the book, we talk about that at length as one of the best measures in order to evaluate the price of an individual stock. So if you haven't got your copy of our book, Next Gen Dollars and Cents, know that we extended our free offer to mail out a hard copy of that book until January 31st. We were only going to do it till December 31. Unfortunately, Amazon, it's all sold out, so it's taking some time with the holidays for them to kind of get that back into supply. So consequently, we decided, hey, we're just going to extend the free offer of the hard copy of the book Next Gen Dollars and Cents until January 31st. So you still have an opportunity for the next month to request your free copy of that book. But one of the concepts that we talk about when we talk about stocks, in the chapter on stocks, we talk about how you evaluate individual stocks. One of the best ways to evaluate individual stocks is to look at something called the price earnings ratio, the PE ratio. And what that is for a certain amount, for a dollar of price, if you will, how much do you have to spend to get a dollar of earnings, right? So how many dollars do you have to spend in order to buy a company and have that dollar, if you will, be represented by earnings or a dollar's worth of earnings in that particular company. So I'll give you an example. So when we think about PE ratios, usually like those historically be between 10 and 15 in terms of the PE ratio. And the reason for that is if you think about it this way, okay, if I'm going to buy a stock that is $10, and then that stock is going to generate a dollar's worth of earnings, then that means that over an extended period of time, I basically wind up earning back the amount of money that I spent to purchase that stock, right? So that's at a stock that would have a PE of like 10, right? So I spend $10 for a dollar's worth of earnings. And so that means that for that particular stock, it's going to have a PE ratio of 10, right? Makes sense. I'm not overspending for a dollar's worth of earnings per se, particularly in terms of historical figures, in terms of historical numbers. So with that in mind, let me give you the current PE ratios of those 7 companies that are some of the most hyped companies on the planet these days. And this is as of the end of the year, roughly around the end of the year. The folks at Alphabet had a PE ratio of 28. Folks at Facebook had a PE ratio of 32. That means you're going to spend $32 for a dollar's worth of earnings. That seems expensive, right? If you got to spend $32 to get a dollar's worth of earnings, especially when you can find other companies whose PE ratios may only be 10 or 12 or 15, wait a minute, then I'm having to spend twice as much money. When I got a PE ratio of 30 versus a PE ratio of, say, 10, I'm having to spend 3 times as much money for the same dollar of profit, the same dollar of earnings from that particular company. So if you think Amazon and Facebook at around 30 PE are expensive, well, guess what? Apple's is right there as well at around 30. Microsoft a little bit above 30 at about 35. Now, hold on for the next 3. So that's 4 of the Magnificent 7. PE ratios around 30 to mid-30s. That's kind of pricey. So let's flesh out the remaining 3 of the Magnificent 7 that have driven a lot of the hype in the markets. That would be the AI chip maker NVIDIA. The PE ratio there is 65, if you think that's rich. How about Amazon at 80 or Tesla at 82? Folks, these PE ratios are very high. What that means is that these companies are very highly valued. And that's fine, but the reality is if you're going to spend $80 to get a dollar's worth of earnings out of Amazon, what about maybe a company where you only got to spend $10 to get that same dollar's worth of earnings? Doesn't that sound like a better investment, right? If we think about investing as buying things that are on sale or buying things that make sense from a cost perspective, don't you want a PE ratio that might be 10 or 15 or hey, maybe 20 and not 80? We think that's going to be an issue. We think that's going to be an issue here in 2024. And certainly history is our guide for saying that that can be a big issue when you have a very small number of companies that's driving the market And these valuations are as lofty as these numbers that we're sharing with you. So we're going to continue this conversation after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning.